Are you an investor looking to grow your portfolio over time through dividends? Have you heard of drip investing? What does that mean and why would you want to do this? All of these questions and more answered in today's video. Hey, welcome to Finance, the channel centered around your financial education to help make you a better investor. If you find my videos helpful and want to see more, be sure to subscribe as I upload new investing videos every week. Alright, let's get into the video. In investing, the word DRIP is an acronym that stands for Dividend Reinvestment Plan. This is a specific investing plan that when you are paid dividends, your dividends will be automatically reinvested back into your portfolio. This is a popular strategy among those new to investing or those looking to build up their positions in the stocks that they already own. Investors love DRIPs because dividends can be automatically reinvested without incurring any transaction fees, and you can also buy partial shares. So even if you only receive something like $5 in dividends, you'll be able to reinvest those $5 by buying partial shares and without paying any fees. Although commission-free trading is certainly more popular than ever, many investors are still stuck paying the $5 to $10 in fees. Anything you can do to reduce or eliminate these fees will be worthwhile in the long run. Cool, that sounds great, but how can I set this up? What you need to do is go to your broker or the trading platform you use to buy stocks and ask them to set up the DRIP for you. Usually, you will need to decide from the stocks you currently own which ones in particular you want to DRIP. It's not the type of system that either you DRIP your whole portfolio or you don't. You can have a bit of both. You need to choose which specific stocks will be set up under the DRIP, so if you have a few solid companies you'd like to hold on to for the long run, these are good candidates. Any dividends paid from these stocks will be automatically reinvested for you and will help you grow your positions. Once you have it set up, the dripping will continue forever until you cancel the DRIP option on those stocks. So now let's talk about some benefits of DRIPs and why you may want to set this up for yourself. First off, DRIPs are great for the set it and forget it type of investing. Without any effort from you, your dividends will be automatically reinvested back into your portfolio. They can help you achieve compound interest over time through dollar cost averaging. The idea is that with each dividend payment, you will be able to buy a little more stock, which will pay you a little more dividends, which buys you even more stock, and so on. DRIPs also allow you to buy partial shares. What this means is that if the current stock price is something like $75, but you only have $25 to invest, you'll be able to buy a third of a share. This is extremely useful for new investors looking to make every dollar count. Additionally, transaction fees can make a huge impact if you are investing small amounts at a time. If you were to invest $100 and pay a $10 transaction fee, that's an instant 10% loss on your investment. So if you can dodge the fees by setting up a DRIP, your money will go further for you and improve your performance in the long term. Lastly, companies that offer DRIPs on their shares will usually give you a discount off the current price of the shares when your DRIP automatically reinvests. This discount will vary from company to company, but you can expect to get a 1 to 3% discount off the current price of the shares. Nice! Before I wrap up this video, I would like to mention some of the drawbacks when it comes to DRIP investing. When you set up a DRIP, the dividends are only reinvested back into the company that they came from. So if you're collecting dividends, but you want to buy a different stock with those dividends, this wouldn't be possible with a DRIP. Of course, you can use your own money to buy into new stocks that you don't already own, but the dividend that your portfolio generates will only go back into your existing positions. Also, since DRIPs automatically buy in when the dividend is paid, one could make the case that you may be buying at a bad time if the stock is overvalued. Although yes, I do agree with this argument in principle, in practice, I'd say it's much better to keep accumulating stock and earning yourself more dividends. There's a famous quote in investing. It goes, "Time in the market beats timing the market." So keep that in mind. Finally, taxes still apply on DRIPs. Even though you don't see the money, since it is automatically reinvested, you still owe taxes on this money. Regardless of how you use your dividends, they are always going to be taxed, so make sure to understand the tax implications for your specific region and tax situation. Thanks for watching today. If you enjoyed the video, be sure to subscribe as I upload new financial education videos every week. Check out my playlist on screen now for more videos like this one. Did you learn something new throughout the course of the video? If so, hit the like button. And as always, if you have a question, leave me a comment and I'd be more than happy to help. See you in the next one. Bye.